The reality though is, if this conversation was had when the person is physically fit and healthy, then it doesn't come across as being opportunistic, but just more logical and realistic. I come from a background of having exited 2 partnerships successfully. One of the partnerships was with my brother. And one thing that we were always concerned about is what would happen to the other if one of us had to pass away. What would happen to the shares in the business? One of the insights that I had as being a partner in the business and also being from the life insurance business per se was to successfully manage a transfer of shares from one party to the other. The clear concern that each of us had was, would either of us want to be in partnership with the deceased partner's spouse or heirs? And we were both very clear about the fact that our partnership was based on our skills, our strengths, and our weaknesses. And that's how we became partners. Our spouses may not have the same know-how about the business or be able to pick up after the spouse in the event something happened. So the big concern really over here was, what would happen to the deceased partner's shares? The simple answer to that would be that the deceased partner's shares would have been purchased by the surviving partner. The next question then is, how would the liquidity to purchase those shares come from? Where would the money come from? The solution was really simple. Our company purchased a life insurance policy on both our lives. In the event one of us passed away, there would be a large value life insurance payout, which would be paid into the company. Those funds would then be utilized to buy the deceased partner's shares out. This would then settle completely to the heirs what is owed to them. And as a result, the surviving partner would not need to be in a partnership with the deceased partner's spouse. If you think about this, this is a pretty unpleasant conversation to have with your business partner mid-term during your partnership. What would happen if one of us passed away? A lot of business owners don't want to address that situation because it talks about the uncertainty. Family businesses have an additional layer of complexity when having this kind of a discussion, because apart from the business angle, they now also have to speak about the possibility of a family member not being around and the result thereof of shares not being transferred down in the right manner. The truth, however, is most family businesses don't pass the second or the third generation. I think with family-owned businesses, there is an added level of complexity which surrounds the insensitivity that comes from talking about death of a potential family member who's also a business partner. Regardless of the outcome, having that conversation is imperative because this would allow for better succession planning and maybe creating enough liquidity to allow the next generation to opt out of running the family business if that's not their chosen career path. The primary reason for having a partnership insurance policy in place is to create liquidity. Liquidity for the purpose of being able to purchase the shares of the deceased partner's heirs. The secondary objective of this policy is to address any potential key man insurance requirements. A key man insurance policy or a key person insurance policy is a policy that can be purchased on, as the name suggests, key people in the organization. This could be your top sales guy, it could be your CEO, it could be the CFO of a business, it could be anybody whose role impacts the company's bottom line tremendously. The key person in the organization is probably responsible for a portion of the profits in the business. The idea behind the life insurance policy being put in place is to ensure that those losses are dealt with by liquidity that's created from the life insurance payout. It's usually a multiple of that profit or that loss that's taken into account.